Welcome back, traders and investors. We have another author on the line here. We have Mark Melin. He's the author of ValueWalk and an alternative investment practitioner. Adjunct professor in managed futures at Northwestern. Mark, how you doing today?
Not good, thanks. How are you?
Not doing too bad. So, uh, you want to talk about the Argentina Elliott battle that's going on. Could you give us some background on that?
Sure. This actually has some pretty wide ramifications. Right now, Argentina is in a battle with what's called the holdout hedge funds, who are trying to get Elliott to pay previous bondholders on debt they defaulted on in 2001. Now, when Elliott bought this debt, they purchased it from previous bondholders. When Argentina defaulted in 2001, they ultimately came to an agreement with the bondholders to pay 30 cents on the dollar. So consider that if you're an investor, you're invested in a bond, you get 30 cents on the dollar back. Well, Elliott purchased these claims to the bonds for essentially pennies on the dollar, and after the bondholders settled with the government of Argentina, Elliott's saying, no way, I'm not accepting this. And so Elliott is all about trying to get Argentina to pay in full. Now, here's the catch, and here's where the implications come in for global debt restructuring. Argentina doesn't have the money. Think about a homeowner who's upside down and you ask him to pay the credit card bill. It's not going to happen. So Elliott and Argentina have been fighting this battle in court. And it went all the way to the Supreme Court, who's deciding if they're going to hear the case. Now, here's where it gets interesting. We reported in ValueWalk that there was a secret memo that was leaked between Argentina's New York-based lawyers. And in this memo, it essentially advised the Argentine government to ignore court rulings based on how certain people portray it. If you listen to the people on Argentina's side tell the story, they say that essentially the default was one option. Quite frankly, in my own speculation, the default is the primary option. And if Argentina loses this case, they're probably going to default on all the bond agreements, in my opinion, based on what I've seen from both sides. So it's very interesting. Now, here's where the new twist is coming in today in an article we're going to publish on ValueWalk. The Pope Francis is getting involved in the debate. Essentially, a group called Jubilee USA, who filed an amicus brief on behalf of Argentina, had a meeting with the Pope 2 weeks ago, March 21st. And they presented the amicus brief. When the gentleman from Jubilee USA walked out of the meeting, he used the term savage capitalism to describe what Elliott and these holdout hedge funds are doing to Argentina and other developing nations. You know, this isn't a problem. This isn't a one-off with Argentina, as a lot of people would have you believe. You know, the same debt problem is at the root of what happened in the Ukraine. You don't hear this much in the mainstream media, but before any of that Ukraine blew up, there was a disagreement over debt. The IMF wanted some pretty strict terms and some tough austerity that they were imposing on Ukraine. And then Ukraine turned to Russia for better debt terms. You don't hear that much in the media, but that's at the root of it. So Ukraine, there are a host of other countries that are having significant difficulty with their debt, and they're faced with one of two things. And here's where it gets kind of scary, and this is going to come out in the article today. If you go back in history, 1933 Germany, you know, severe debt restrictions were imposed on the German people. They had to pay war reparations and as a result of the Treaty of Versailles. What happened? Adolf Hitler came to power. So that's the negative. So then in the article, Eric Lecomte from Jubilee talks about how in religious writings, there's the concept of a jubilee, debt forgiveness. So if you're religious and you follow the Bible, every 50 years, there's supposed to be this concept of jubilee, forgiveness of debt. And so that's what they're essentially trying to apply to the Elliott case, and that was the context of the meeting between Jubilee and Pope Francis. So in my experience covering hedge funds and working on the inside of the hedge fund industry, I have never seen a pope talk about hedge funds before, so this is definitely going to be a first.
Yeah, definitely. A lot of implications for that worldwide then, correct?
Absolutely. Because here's what's going to happen. There are a couple implications. Number one, it could have implications on the New York bond market. Eric LeCompte in the article outlined that if the Supreme Court rules against Argentina, what you're going to see is instead of underwriting bonds taking place in New York, it could take place in London, Frankfurt, or Paris. And all those places have existing structures for how to manage the bankruptcy of a sovereign government. And, you know, the debt crisis is generally undiscussed in the mainstream press, but it's behind the scenes. There's always been a huge discussion that the debt that the countries are piling up is mathematically impossible to repay. You know, and so these are mathematical discussions. These aren't subjective discussions. If you just look at the math, and even the U.S. government, if you look at the underfunded liabilities we have right now, and, you know, you read any of the work of Professor Larry Kotlikoff of Boston University and some other scholars, the debt picture that's painted to most Americans and the real debt picture that hedge fund managers, such as, oddly enough, Paul Singer, Seth Klarman from Baupost, all these guys are pioneers. Ray Dalio, all these guys have come out and said that the debt is a problem. And also, FYI, the unregulated derivatives that the big banks have piled up to $600 trillion. Arthur Levitt called that a doomsday machine. You don't hear that in the mainstream press,
No,
but these
not
are
at
the
all.
issues that need addressing, and they're not being addressed.
Okay. Also, you do some writing on HFT, and you think it boils down. Where Dennis loves talking about HFT. You think it boils down to one primary issue. Will you share that with us?
Absolutely. I had a conversation with Eric Hunsater yesterday, and if you don't know Eric Hunsater, most people don't because he doesn't get a lot of press, but he has a one-man army against the HFT contagion. And so Hunsater is an expert witness in a lawsuit that was revealed over the weekend, but was actually filed back in March, a couple weeks ago. And essentially, the lawyer for Big Tobacco, remember that settlement in 1994, I think it was, 13 tobacco companies agreed to pay $368 billion? Well, the lawyer behind that landmark settlement is a guy named Michael Lewis, not the author, lawyer, different guy. And he is backing this lawsuit against the HFT firms. Now, here's the background of HFT. If you're on the inside, you know that what's happening is they're trying to disguise the real issues. You know, it's all about obfuscation. And just look at it clearly. And at the center of Hunsater's thoughts and this legal argument is the argument that what's being sold is access to market-moving information before the general public gets it. Okay? So forget about all the technologies that they tell you about. When you spend $60,000 per month, which is the cost to get access to this information, you are getting market-moving access before the general public. So, you know, on Benzinga, a lot of people are investors, retail investors. Guess what? You are being front run every single day. And anyone wants to bring that up? Bring it up. Tell the truth, though. You can buy access to market-moving information. Guys like Bart Chilton. Now, here's the backstory that hasn't been told. Guys like Bart Chilton have been fighting behind the scenes on this issue, and there was actually a big fight between regulators. When the whole flash crash happened in May 6, 2010, you know, there was a story about what really happened that wasn't told. And that SEC report that came out and was shoved down the throats of the CFTC based on my speculation and the sources that I've spoken with, when that came out, that was a joke. People inside the trading community laughed at it. I mean, talk to market makers. They knew what happened. There was a manipulation of the electronic eye and the market-making software that occurred. Where's that in the report? Where's the fact in the report where Dell & Reed, the mutual fund, was selling on the ask? So it wasn't just like a fat finger. Whoops! I just executed a trade for $4.1 billion short E-mini. That's not what happened. So there's a lot of that HFT that, quite frankly, the fact that none of this is in the mainstream is just ridiculous to me.
Okay. All right. So we're going to close out the interview here. I mean, just taking everything into consideration here, with the markets and potentially the decision over in Argentina with the bonds, and what's your call on the market here? It's had an incredible run. Do you see that coming to an end anytime soon? Some kind of event like what's going on in Argentina could kick off things in Europe, which could spread here, or is this just something that the market's just going to pass over again and continue higher?
Well, let's talk about markets because this is interesting. I'm going to be speaking on a Reuters Hedge World panel June 24th where we talk about volatility. Now, there are traders, quantitative algorithmic traders, who say that volatility can be predicted. Okay, so their models, they say, predicted the 2001 event, not the fact that terrorists were bombing or anything specific, but there was abnormal behavior before September 11th, 2001 in the market that their algorithmic sensors picked up. Then in 2008, same thing. These volatility traders, their algorithms noticed unusual patterns in the market before September 2008. So you're asking when it's going to happen. I don't know when it's going to happen. I tend to think that this market is built on stimulus. This market is built on quantitative easing. That's a house of cards built on a foundation of sand. So it's I don't think it's so much a matter of if this market's going to crash. It's a matter of when. Now, my personal speculation on when that's going to happen, I think it's 2015. I think Yellen's going to be Yellen is, in my opinion, is actually doing a pretty good job. I mean, think about this woman. She was handed just this absurd situation. They went off the playbook. This isn't in any textbook. The size of their balance sheet and how they're going to unwind this is just absurd. So I think kudos to Janet Yellen because I think she's doing a great job of unwinding it. I think at the end of the day, there's going to have to be a market crash. The markets move in cycles. When they're not manipulated, markets move in cycles. That's the core principle of algorithmic trading. What's happened, since the Fed and quantitative easing has come in, the cycles aren't there anymore. The normal cycles that you would see in a market just are very different. That also is probably one of the reasons why you see managed futures guys performing, subpar. Now that in itself brings up a pretty big argument because, guys like David Hardy and Winton Capital say that the manipulation of the markets doesn't impact the managed futures guys, but I think it does.
Okay, Mark, thank you so much for coming on for your knowledge and certainly your passion for these subjects. We'll definitely be following the situation over there with Argentina and the implications that we'll have on our markets. Always looking for a catalyst to change, send markets the other directions. Thanks for your input on high frequency trading, and if available, we sure like to have you back on the show again.
Okay, I hope I didn't scare you. I'm really a nice guy, so
yeah, that's okay. I scare a lot of people too, so don't worry about it. And just to let you know, we've had Eric on the show here before, and that discussed his views. So we liked having him on, and you as well. So we'll talk to you again soon.
All right, take care.